Have you ever played a game of musical chairs? Everyone's happy as long as the music plays, but when it stops, someone's left without a seat. Now, imagine that game, but with the entire world's economy. The chairs are houses, and the players are banks, investors, and regular people like you and me. That's essentially the story of the 2008 financial crisis. And today, we re-go in to uncover the untold secrets behind how this simple game brought the global financial system to its knees. It all started with a simple, powerful idea: the American dream of owning a home. In the early 2000s, interest rates were super low, making it incredibly cheap to borrow money. Banks were eager to lend, and everyone wanted a piece of the booming housing market. Prices were going up, and it felt like the party would never end. To get more people into homes, banks started offering what are called subprime mortgages. These were loans given to people with low credit scores or unstable incomes, people who traditionally would unqualify for a loan. On the surface, it seemed like a good thing, helping more families own a home. But here's where the first domino was set up. The banks knew these loans were risky. So what did they do? They didn't want to hold on to all that risk themselves. This is where the financial wizardry begins. Instead of holding on to these individual risky mortgages, investment banks decided to bundle them together. Imagine taking thousands of these home loans, some good, some okay, and a lot of them pretty risky, and mixing them all up into a giant financial smoothie. They called these bundles mortgage-backed securities, or MBS. Then, they took it a step further. They sliced these bundles into different pieces, like a pizza, and sold them to investors. The top slices were rated AA, supposedly as safe as government bonds, because the theory was that even if some people defaulted on their loans, most would keep paying, so the overall investment would be safe. It was like hiding a few bad apples in a giant barrel of good ones. The ratings agencies, the very watchdogs meant to protect investors, gave these complex products their highest ratings. They were essentially saying, "Don't worry, this stuff is solid gold." So, who was buying these financial products? Everyone. Pension funds, which managed retirement money for millions of teachers and firefighters. Foreign governments, insurance companies, and even other banks. They were all hungry for a safe investment that paid a better return than simple government bonds, and these mortgage-backed securities seemed like the perfect answer. The global financial system became interconnected in a way it had never been before. Trillions of dollars were flowing into these products, all built on the assumption that house prices would keep rising forever and that people would always pay their mortgages. It was a giant global bet on the American housing market. The music in our game of musical chairs was getting louder and faster. Banks were making a fortune selling these products. Investors were getting great returns, and the housing market was on fire. What could possibly go wrong? Well, the music had to stop eventually. The problem with making it easy for everyone to get a loan is that it artificially inflates demand. House prices got so high that they became disconnected from reality. At the same time, many of those risky subprime mortgages had adjustable rates. After a few years, the low introductory interest rates jumped up, and suddenly, homeowners' monthly payments skyrocketed. People who were already struggling couldn't afford their new higher payments. One by one, then 10 by 10, then thousands by thousands, people started defaulting on their loans. Couldn't pay, and they couldn't sell their homes because the market was flooded and prices were starting to fall. This is when the house of cards began to wobble.
I remember those safe bundles of mortgages.
The bad apples were starting to rot the whole barrel. As defaults climbed, the value of those mortgage-backed securities plummeted. The AA aerated slices that were supposed to be solid gold were suddenly revealed to be worth next to nothing. Panic erupted on Wall Street. Banks and investors realized they were holding trillions of dollars in worthless assets. Nobody knew who was holding the bad debt, so nobody trusted anyone. The flow of money, the lifeblood of the economy, seized up. Banks stopped lending to each other, to businesses, and to individuals. It was a full-blown credit crisis. Lehman Brothers, a 158-year-old giant of Wall Street, had bet heavily on these toxic assets. In September 2008, it declared bankruptcy, sending a shockwave across the globe. This wasn't just some distant Wall Street problem anymore. It It was like pulling a critical Jenga block from the tower. The entire structure collapsed. The stock market crashed. Major companies like the insurance giant AIG were on the brink of failure. The world was staring into the abyss of a complete financial meltdown, worse than the Great Depression. The game of musical chairs was over, and there weren't nearly enough chairs to go around. Faced with a total economic collapse, governments around the world had to act. In the United States, the government approved a controversial $700 billion bailout package, known as TARP, to inject money into the failing banks. The idea was that these banks were too big to fail. If they went down, they'd take the entire economy with them. They used taxpayer money to buy up the toxic assets and stabilize the financial system. It was a painful choice, rewarding the very institutions that caused the crisis. But the alternative seemed far worse. Despite the bailouts, the damage was done. The crisis spread from Wall Street to Main Street. Businesses that could no longer get loans had to lay off workers. Millions of people lost their jobs. Millions more lost their homes to foreclosure. The ripple effects were felt for years, leading to a long and painful global recession. So, what's the ultimate lesson from this story? It's a powerful reminder of how fragile our economic systems are. It's about what happens when greed outweighs caution, when complexity is used to hide risk, and when the watchdogs fall asleep. The 2008 crisis showed us that when trust is broken on a systemic level, the consequences can be devastating for everyone, not just the players at the top. It forced us to rethink financial regulation and the interconnectedness of the global economy. The story isn't just about numbers and charts. It's about the real-world impact on millions of lives. And it serves as a crucial warning that we must never forget. Thanks for watching. If you found this explanation helpful, please hit that like button and subscribe for more deep dives into the events that shape our world. See you next time.